A Ponzi scheme is a fraudulent investment operation promising high returns with little risk. They rely on new investors' money to pay earlier investors, creating an illusion of profit. Without a legitimate underlying asset, these schemes eventually collapse, leaving investors with significant losses. Understanding these characteristics helps protect individuals from fraudulent investments. The Australian property market has seen soaring prices in major cities, driven by low interest rates and population growth. However, affordability remains a concern as wages haven't kept pace. Government measures like stricter lending rules aim to cool the market. Experts are divided on whether the market is overvalued or supported by strong demand. Over the past decade, Australian house prices have surged, particularly in Sydney and Melbourne. This growth, fueled by low interest rates and population growth, has led to unprecedented household debt levels. The ratio of household debt to income has surpassed 180%, raising sustainability concerns. Rental affordability has also become a pressing issue, pushing essential workers out of urban centers. Investors, both individual and institutional, play a significant role in the Australian property market. Institutional investors, like superannuation funds, often drive up prices, making it harder for individual buyers. Government measures aim to balance foreign investment with affordable housing access for Australians. The Australian dream of homeownership is becoming elusive, especially for younger generations. Soaring house prices and stagnant wages have profound social and economic consequences. Essential workers are being priced out of the areas they serve, leading to workforce shortages. Addressing this crisis requires increasing affordable housing supply and tackling income inequality. Ponzi schemes use new investors' money to pay earlier investors, creating an illusion of profitability. These schemes lack a legitimate business model and rely on constant recruitment of new investors. Eventually, they collapse, leaving behind financial devastation and shattered dreams. History is filled with Ponzi schemes, from the Dutch tulip mania to Bernie Madoff's $65 billion fraud. These schemes share common threads: charismatic leaders, unsustainable practices, and eventual collapse. They serve as a reminder that if an investment sounds too good to be true, it probably is. High returns with little risk, lack of transparency, and pressure to invest quickly are red flags of Ponzi schemes. Be wary of complex investment strategies and unsolicited offers. Always research thoroughly and consult a trusted financial advisor. The Australian property market and Ponzi schemes both involve rapid price increases and new investors. However, the property market is based on tangible assets and regulated by government policies. While there are concerns, the market's intrinsic demand for housing provides stability absent in Ponzi schemes. The Australian property market's reliance on continuous price growth is concerning. Many investors are highly leveraged, assuming prices will keep rising. This dependency creates a precarious situation if the market stalls. A shift towards sustainable investment models is needed to break this cycle. Another aspect of the Australian property market that raises concerns is the prevalence of speculation. Speculation, in this context, refers to the practice of buying property not for its intrinsic value as a place to live or generate rental income, but rather with the sole intention of selling it later at a higher price. While some level of speculation is inherent in any market, excessive speculation can create artificial bubbles, driving prices far beyond what is justified by underlying economic fundamentals. This can lead to market instability, as prices become increasingly detached from reality. Several factors contribute to speculation in the Australian property market. Low interest rates, as mentioned earlier, have made it cheaper to borrow money, fueling demand for property. However, when these low rates are combined with lax lending standards, it can lead to a situation where people are encouraged to take on more debt than they can comfortably manage. This can create a systemic risk, as a sudden increase in interest rates or a downturn in the economy could trigger a wave of defaults. Furthermore, the tax system, with its favorable treatment of capital gains, incentivizes speculative behavior. Investors are more likely to take on risk if they believe that any profits will be taxed at a lower rate than other forms of income. This can create a moral hazard, where investors are encouraged to engage in speculative activities that they might not otherwise consider. Addressing the issue of speculation requires a multi-pronged approach. Strengthening lending standards, ensuring that borrowers can comfortably manage their debt, is crucial. Tax reforms that level the playing field between different asset classes, such as reducing the capital gains tax discount, could also help curb speculative activity. The question of whether the Australian property market is a Ponzi scheme ultimately hinges on whether its current trajectory is sustainable. Proponents of the market's stability point to strong underlying fundamentals, such as population growth, a robust economy, and a chronic undersupply of housing. They argue that these factors will continue to support demand for property, ensuring that prices remain high. Moreover, they emphasize that the Australian property market is not monolithic. While Sydney and Melbourne have experienced significant price growth, other cities and regional areas have seen more moderate increases. However, skeptics argue that the market's dependence on continuous price growth and the prevalence of speculation paint a different picture. They point to record levels of household debt, stagnant wage growth, and rising interest rates as warning signs of a potential correction. They argue that the market is overvalued and that a significant price drop is inevitable. The truth, as is often the case, likely lies somewhere in between these two extremes. The Australian property market is not a Ponzi scheme in the traditional sense. It is based on a tangible asset with inherent value. However, certain aspects of the market, such as the reliance on price growth and the prevalence of speculation, do raise concerns about its long-term sustainability. Addressing these vulnerabilities is crucial for ensuring that the market remains stable and accessible to all Australians. This requires a multifaceted approach, involving government policies, lending practices, and a shift in mindset away from the expectation of endless price growth towards a more sustainable model based on realistic returns and long-term value. Only by addressing these underlying issues can we ensure that the Australian dream of homeownership remains within reach for future generations. On one side of the debate, we have a chorus of voices: economists, property developers, and even some policymakers who maintain that the Australian property market is fundamentally sound, and its recent growth, while dramatic, is a reflection of real demand and a strong economy. They argue that Australia's robust population growth, fueled by immigration and a relatively young population, underpins the demand for housing. This demand, coupled with a chronic undersupply of new homes, particularly in desirable urban areas, creates upward pressure on prices. Furthermore, proponents of the bull case highlight the Australian economy's resilience, with consistent growth, low unemployment, and a stable financial system. They argue that these factors make Australia an attractive destination for both domestic and foreign investment, further boosting demand for property. They also point to historically low interest rates, which have made mortgages more affordable, enabling more people to enter the property market. While acknowledging that affordability is a concern, particularly for first-time buyers, they argue that government initiatives, such as first home buyer grants and stamp duty concessions, are helping to mitigate these challenges. They often cite data showing that despite rising house prices, mortgage stress levels remain relatively low, suggesting that most borrowers can comfortably manage their repayments. They also emphasize that the Australian property market is not homogeneous. While Sydney and Melbourne have seen the most significant price increases, other cities and regional areas have experienced more moderate growth, suggesting that the market is not in a nationwide bubble. In their view, the Australian property market, while undoubtedly cyclical, is underpinned by solid fundamentals that will continue to drive growth over the long term. In stark contrast, a growing contingent of experts, economists, financial analysts, and social commentators are sounding the alarm bells. warning that the Australian property market is in the throes of a dangerous bubble fueled by unsustainable debt, speculation, and government policies that have distorted the market. They argue that the current trajectory of house prices is detached from economic fundamentals, with prices far exceeding what average Australians can afford. They point to record levels of household debt, which have reached alarming proportions relative to incomes, as a sign of systemic risk. They argue that this debt-fueled growth is unsustainable, and that a significant correction is inevitable. Furthermore, they criticize government policies, such as negative gearing and capital gains tax discounts, which they argue have incentivized speculation and favored property investors over first-time homebuyers. They contend that these policies have artificially inflated demand and driven up prices, exacerbating affordability problems. They also express concerns about lax lending standards, which they believe have allowed borrowers to take on more debt than they can realistically manage. They warn that a rise in interest rates or an economic downturn could trigger a wave of defaults, potentially destabilizing the financial system. They often draw parallels with historical property bubbles, both in Australia and internationally, highlighting the devastating consequences of these bubbles bursting. They emphasize that while every market is different, the underlying dynamics of debt-fueled speculation and market psychology are often eerily similar. They believe that without significant policy changes to address affordability, curb speculation, and reduce household debt, the Australian property market is heading for a painful correction that will have far-reaching economic and social consequences. To navigate this complex debate, it's essential to delve into the data and analyze key metrics of the Australian property market. One critical indicator is the house price-to-income ratio, measuring housing affordability. In Australia, this ratio has been steadily increasing, indicating houses are becoming less affordable. The median house price is now more than 8 times the median household disposable income. This places Australia among the most expensive housing markets globally. Is the Australian property market a Ponzi scheme? It's not a simple question. There are valid arguments on both sides. Price growth, speculation, and easy credit have created bubble-like conditions. Continuous price appreciation and quick profits drive the market. But the market is complex, influenced by many factors. Regional areas show sustainable growth driven by genuine demand. Unlike a Ponzi scheme, the market is backed by tangible assets. Homeownership remains a key aspiration for many Australians. Government measures aim to curb speculation and promote stability. It's crucial to engage in a nuanced, data-driven analysis. Rather than getting bogged down in the semantics of whether or not the Australian property market constitutes a Ponzi scheme, a more productive approach is to focus on the path forward. How can we ensure that the market remains stable, accessible, and beneficial to all Australians? Achieving this goal requires a multi-pronged approach, addressing the underlying factors that have contributed to affordability challenges and market volatility. One crucial area for attention is housing supply. Addressing the chronic undersupply of housing, particularly in desirable urban areas, is essential for alleviating upward pressure on prices. This requires a combination of planning reforms to streamline development approvals, government incentives to encourage the construction of affordable housing options, and a willingness to embrace innovative housing solutions, such as higher density living. Another area that demands attention is the issue of household debt. As we've discussed, Australia's high levels of household debt, largely driven by mortgage borrowing, pose a significant risk to the economy. Encouraging responsible lending practices, promoting financial literacy, and fostering a culture of saving over excessive borrowing are crucial steps in mitigating this risk. Furthermore, addressing the tax incentives that have fueled speculation in the property market is essential. Reforming negative gearing and capital gains tax discounts, while politically challenging, could help to level the playing field between investors and first-time home buyers, reducing speculative demand and promoting a more sustainable market. Ultimately, creating a stable and accessible property market requires a long-term perspective, one that prioritizes genuine housing needs over short-term profits and recognizes that a home is more than just an investment. It's the foundation for a secure and fulfilling life. By focusing on these fundamental challenges and embracing a balanced and evidence-based approach, we can strive to create a property market that works for all Australians, ensuring that the dream of homeownership remains within reach for generations to come.